Hi, good afternoon. Josh Blum here. Thanks for joining us. We're at 12:30 sharp. I'm here with my friend and colleague and moderator, Mr. Steve Taylor, president of the local Miami chapter of the Financial Planning Association. And we're here to offer you our CE course, Incorporating the Housing Asset into Retirement Planning. I wanted to give Steve an opportunity not only to act as moderator, but talk to you for a minute or two about what the FPA is and what they're able to accomplish in our local community. So, Steve.
Thanks, Josh. So we're really excited to have you and to have this presentation, which is really going to become a mainstay of what we're trying to do as an organization. So for any of you that aren't familiar, the FPA of Miami is the Financial Planning Association. Our purpose is to support financial planning and financial planners in their practices, and to further the profession truly through adding value to our members. And so what we are doing, like a lot of the other groups out there, is now in this new world, we're unable to meet together. We are trying to bring value and content to our clients and our members really any way we can. And so Josh this is a really great opportunity. Josh is a tremendous guy, tremendous at what he does. This is probably a resource and a product that, to be quite honest, many people will say in the back, many years in the past, it's had a bad name, but it's really, as him and I have talked about, and I've used it for many clients, it's such a valuable, important resource. It's really important for everybody to understand. And so what we'll be doing today, this is our first time. I'm moderating, so I'm not going to be speaking. That's Josh. Please pay attention to the chat. Put all your questions you have in the chat. We're going to also be putting polls out there and asking questions throughout. So anything there, and throughout the time, Josh will be pausing to allow for questions, and basically just put those in the chat, and he'll either read them or I'll read them out to him. And hopefully, this will go really smoothly. I know it will, and that you'll get a lot out of it. So thanks, Josh.
Steve, thanks for joining us. And right off the bat, Steve mentioned there's some resources here online you might not be as familiar with. On the right-hand side, you're going to see that chat box. Feel free to type in there if you have any questions, you have any comments. We'd love to have some interaction. We'll be keeping an eye on it, and Steve might pause me from time to time if you bring something up so we can discuss it in more detail. We do have polls, and we're just going to put one out here right now so you have a chance to see this, and we're just hopeful we can get some responses. We're here to support the FPA, and I can see we already got some answers. We've got, are you a member of the FPA? No, but I'd be open to learning more, or no, I'm not at all. So as you can see, we're already getting some responses in. We've got a third of the audience here responding, so thank you all. We'll have some poll questions throughout. Steve should be able to pull these up for us as we're ongoing. So I'm going to go ahead and I'm going to pull up the presentation here. And before I really go into details around this, I want to just cover some housekeeping. This is CE. It's provided by the Retirement Resource Center. It's a really phenomenal presentation, but it's a long deck. It's 43 slides. And it is a lot to get through. What you need to know is it has to be a minimum of 50 minutes in order to get credit. And so if you do want credit, you just have to be in attendance for the entire session. It should be about 50 minutes or so. There is an opt-in for the CE certificate email. You can opt out immediately afterwards if you want. It's the other requirement. And the third requirement is just make sure, and we're going to put a handout out right now, Steve, if you can, to fill out the course evaluation. It's the third thing we need you to do. So I'm going to send it to you right now. You should see it popping up as a download. That is your evaluation form. You do need to fill that out. I'll be submitting this back to the Retirement Resource Center by Monday, and you should have everything processed and receive an email about your credits by the end of next week. So if anybody has any questions around that, feel free to type them in the chat box. Otherwise, I'm going to kick us off and get us started, all right? So incorporating the housing asset into retirement is an interesting topic. It's changed a lot over time. It always, to me, helps to know a little bit about who I am. I'll have Steve also put an About Us slide with Mutual of Omaha Mortgage. That's the lender I work with. But my story is interesting. I went into the financial advisory space right after college. I got my 7 and my 66 in my life and health, and I started picking up the phone. And I knew really quickly it wasn't what I wanted to do. I found what I felt was my calling very shortly after that, and I became a wholesaler. I ended up wholesaling in the financial services industry for over a decade out in California, primarily in the San Francisco Bay Area, for what was one of the largest and the #1 at the time annuity companies in the industry. So I've had a real privilege of working with some of the best advisors in the country across all distribution channels, whether they're agency advisors, whether they were wirehouse, bank, independents, RIAs. I've worked alongside all of them, and I've worked with thousands of clients, especially retirees. That's my specialization. And so it's interesting. I moved to Florida 2 years ago, and I really had to decide, am I going to follow in your footsteps? Am I going to do what you're doing, or do I want to do something different? And it was a pretty easy decision for me. Really, it was, because the one thing that stood out for me when I looked over my career was when I sat across the desk from retirees, there's just a lot of instances where the advisor said, this is the best we can do with what we have. It's like drawing water from a stone, if you've heard that saying before. There is only so much you can do with the tools at your disposal as a financial professional, but it became pretty apparent that there were other resources out there, and really the house was a large one, a really, really large one. To put it into scope and perspective, when we look at housing wealth for baby boomers, it actually represents more wealth than all the 401k assets in this country combined, only for boomers and seniors, right? So not even everybody else's housing wealth. So it's a massive piece of the picture. And I would say it's a large piece of the retirement income puzzle that we're putting together for clients, but it's traditionally been set aside, limited in discussion, or hasn't been discussed at all. What I'd say is ignored. And unfortunately, what we found for most retirees is today, that's not an option. So I want to ask you, and I'm going to have Steve put a poll out here, how many of you have actually had discussions about housing wealth and retirement planning with your clients? You should see this poll pop up. As it does, I want to talk a little bit about the marketplace, because it's changed a lot. In the past, we didn't have some of the risks that we have today. 100 years ago, life expectancy was actually, it ended earlier than retirement began. Most people never retired. The ones that did were lucky, and they never had to worry about running out of money. As you well know, and you've been hit over the head with this, we have the onus on our shoulders today. It used to be that we had pensions that were really secure. You look at Pew studies today, not so much the case. We used to have a whole lot of confidence in Social Security, and yet now we have a lot of instability in Social Security. You can see it on the first page of the statement. And this idea of longevity, of running out of money, it's really pertinent today. Wade Pfau, who you can see on this slide here, just came out and revisited the 4% rule and dropped it all the way down to 2.4%. We look at market volatility. Is this not the fastest down market we've seen in our lifetimes? Yeah. Spending shocks, 26 million Americans without a job today. How many are going to be faced with healthcare costs and LTC events that we can't control as advisors? And I look at the responses to the poll, and it's split. We have, on occasion, some people are discussing housing wealth, and then half the people aren't discussing it at all. And this isn't unusual. I ask this question to a lot of people, and it's really common for us not to have this discussion at all. It's what we've been educated to do in the past, but the reality is very different today than it ever was before, and we need to adapt to change. And Steve, I'm sure you can agree with this. Change can happen really quickly, like what we're seeing with the pandemic. We're all adapting and doing things very quickly, like this online class, for example, and it can happen more slowly. Well, with retirement planning, we've got to make sure we're in front of this, because we don't have second chances in retirement planning. We know that the impact is felt early on in our planning. In the first 10 years, it really drives our success rate. And that's what we've got to measure too. And so this concept, just to be clear, I work with Mutual of Omaha Mortgage. I'm not a financial planner, but the information is not coming from the lending world. What you're going to hear about today is coming from your side of the fence. It's coming from places like the University of Illinois and the Academy of Home Equity and Financial Planning. It's coming from places like John Salter at Texas Tech, Boston College, Robert Merton, a Nobel laureate, people like Jamie Hopkins, Wade Pfau, and Barry Sachs that you can see in the picture here, professors at the American College. This material and what we're looking at today is coming from the thought leaders in the financial services world, and they're really banging the drum. They're really trying to get the word out there. Wow, this is an important topic that we need to have a conversation around. And in particular, there's one tool that makes a whole lot of sense for retirees that's not being considered on a regular basis. And for those of you who know me, you probably know what that tool is. It's the reverse mortgage. And this has a reputation, it has a stigma, and it's really misunderstood. but yet every expert with mounting evidence and every study is really growing on top of each other to show, well, this is a really unused resource that a lot of people should be considering. And we're just going to talk very briefly about what it is. We will compare this to some other options, so don't think we're looking at this alone, but there's a number of reasons that this is a much more beneficial tool for retirees especially than some of the other traditional resources you might use when it comes to housing wealth. The reverse mortgage, first and foremost, there's no personal guarantee on this, right? If I'm doing it, am not obligated to this loan. The house is the sole collateral on the loan. You can see it in the slide here. The house provides the dollars I'm borrowing. It is what's ultimately responsible for this debt obligation, not me, not the borrower. The way it works is it's actuarial in nature. So my life expectancy, my age determines how much I have available today. And if I'm not using the equity in my house today, it's going to grow, and it's going to grow at a guaranteed rate that I'm going to be aware of. And so it's a really unique tool that allows you to access the money in your house. I think the simplest way to think of this, imagine for a moment, do me a favor, just go into your head and say, all right, I'm walking into a bank, what do I see? And who sees a counter with glass and tellers behind it? Probably everybody in the room. And think about what's behind the tellers. You'll probably envision a big fat vault door. It's probably about 3.5 thick feet. And we all know what's behind that door. It's money. There's money behind that door. There's wealth in that vault. Well, that vault is like our house. And a reverse mortgage is simply like getting a combination to the vault and being able to walk back to that vault and get the wealth in our house if and when we need it. That's what makes it so unique. We hold the combination to the vault. Now, there's a whole lot of information coming out about reverse mortgages. It's out there. It gets lost in the media, I think, a lot of times. And Steve, you've probably seen this yourself, where we've had instances where you get a lot of bad news about the reverse mortgage. But I want you all to do me a favor for a moment. How many of you are sitting with a cell phone directly in front of you? If you are, just look at it, just shoot it a glance. That phone, if we went back 20 years ago, you probably wouldn't know what it was. But a phone's a phone, right? Except the phone has changed significantly over the years, and so have reverse mortgages. Now, unfortunately, a lot of the time the media is focused on reverse mortgages that have been around for 20 plus years, and it doesn't reflect the reality of what the tool is today. But we are beginning to see information coming out on places like Forbes, the Journal of Financial Planning, CFA journals, accounting journals, and tax attorney journals. The information is starting to matriculate and work its way out there, but it's relatively new. So we're really talking about something that's innovative in financial planning, and it's just so important to be on the forefront of this to make sure that you're not missing out. Now, as a wholesaler, I used to talk about this slide all the time. This is a great slide to me. There's a 50-50 probability that if I'm healthy at 65 and I'm married, my surviving spouse, probably the wife, is going to live to 92. There's a 1 in 4 chance she's going to live to 97. If our average retirement age is 65, we really need to be prepared to plan for a 30-year retirement. And longevity is what's called the great multiplier. Every risk that goes into retirement becomes multiplied over time. And unfortunately, we don't have a lot of assets to bring to bear for a lot of retirees. And Steve, thank you for asking this poll question. As you can see, what percentage of retirees hold more wealth in their homes than any other asset? This is really interesting. The house is a big percentage of people's wealth. Believe it or not, on average, it's 70 to 80% of a person's wealth. Here you can see back all the way in 2011, the house represented 68% of somebody's wealth. So for 70 to 80% of people, it is the number one asset. How much of an asset is it? It's 68%. And 68% in one individual asset, that's pretty nuts. Could you ever imagine holding 68% of somebody's portfolio in an individual stock? It'd be crazy. You would never think to do that. And yet that's what we're dealing with when we look at housing wealth and retirement. And this number, 68%, is why I was so drawn to working with financial advisors and planners like yourself, because it's so important to recognize that we are just a little crazy if we don't incorporate housing wealth into our retirement planning. If we have probability of failure, if we might not get through retirement, if there is risk, we need to incorporate this We cannot ignore it until the end because it is rhetorical, but it is crazy to ignore housing wealth in retirement when you look at how much of a percentage of wealth it is. So with that said, I'm going to focus specifically on what's called the home equity conversion mortgage. This is about 90% of reverse mortgages today. There are jumbo markets. There are non-FHA insured reverse mortgages, but the home equity conversion mortgage really offers, I'd say, the most utility for retirees. And you need to appreciate this is not something cooked up by lenders. This is not something that Mutual of Omaha came up with or Quicken Loans came up with. This was signed into law by Ronald Reagan. It was enacted by Congress. It came out early in February of 1988, and it was designed in a lot of ways similar to Social Security to begin as early as 62 and to provide a means for people to age in place. And why is that important? Well, 9 out of 10 people, guess what they want to do? They want to age in place. So this is an FHA insured tool. It is not a government program, but it is a government partnered program where the FHA insures it. This can be used for any FHA eligible properties. That could be condos. It usually is villas, townhomes, and single family residences. The insurance arm of HUD also helps support this. So this has, in other words, more security than any other financing option for retirees out there today. And I think that really gets missed. When people hear reverse mortgage, they think risk. It's actually the exact opposite. It offers significant protections other financing does not offer. So first, right off the bat, what's that mean? It means that I have the choice of making monthly payments on this if I want to. I'm never obligated to, but I have the choice. There is no prepayment penalty. Now, it might come as a surprise to you that you can actually make monthly payments on this, because traditionally, if somebody's using a reverse mortgage in the past, it's always as a loan of last resort. The housing wealth has been left to the end. But we know conclusively that's not a good idea. We'll review that in detail. What you need to appreciate is if somebody does have assets, they can manage to this loan. They can make payments if they want to. They don't need to. It's a choice. Secondly, because there's no personal guarantee on it, it's a non-recourse loan. That means your liability can never exceed the value of the house. That means if I'm doing this as a borrower, my estate is never responsible for a debt obligation that exceeds the value of the house. In other words, sale of the house is guaranteed always to satisfy our obligation on this loan. Add to that you have a line of credit feature on it, truly unique in the industry today, a line of credit that's guaranteed to grow and it cannot be canceled, frozen, or reduced. I'm going to compare that in some detail to a home equity line of credit so we can look at the differences, but you need to appreciate that this can be used strategically and set up to help reduce risk, preserve assets, position people better in retirement, and increase income and cash flow. It's a really strong tool. Because you're borrowing money here, it is not income. That means when we're discussing this, we're talking about a tax-free bucket of money we're bringing to bear for people. Yes, there's interest accruing on it, but the proceeds are not treated as income, which means if we're talking $100,000, we're talking $100,000 because there's no taxes being applied to this. Now, I'm going to be the first to admit, and this is really important to appreciate. This tool has changed, and I don't think it was a great tool prior to 2008. I think really it didn't become a secure tool until all the way until 2015. In 2008, in 2013, and 2015, you had some significant changes happen here, and most people aren't familiar about this. Steve, I think we have a poll around this as well. How many of you knew about these changes and were aware of them? Number one, financial assessment analysis. Yeah, I've talked with a lot of advisors over the years, and what I hear from them is, well, you know what? I'm just going to wait. We don't need to do this yet. We'll wait until maybe the client has a few years left, and then we'll look at this as an option. Well, I'm here to tell you that's not a choice anymore. Why is it not a choice? Because there's a financial assessment. That means you have to qualify for this. In the past, you never needed to. You never needed to qualify for this in the past. What it means is if you wait too long, your clients are going to be backed in a corner. There's a really good chance they cannot do this. And yes, I run across this all the time. And it might be as simple as the client didn't share with you all the moving pieces. They might have kept something from you, and now you think you're ready to position them, and they can't be positioned. So this financial assessment, funny enough, a report came out today. 75% of the defaults that happen in the reverse mortgage world are no longer happening since this financial assessment came into play 6 years ago. And so there's massive protection going on that wasn't there in the past. Additionally, for a lot of people, having spousal protection is a must-have. I mean, could you imagine doing something if you're married without spousal protection? Well, we saw that a whole lot in the past. Not only were we dealing with people who wouldn't qualify today, but we had instances where spouses weren't protected. And we also have had reductions in access to equity. Now, I know that sounds bad. Well, you mean you get less out of it if you do it? Well, it's still pretty good. I'd say you're going to see anywhere from 45 to 70-ish% based on your age, access to equity in the home. But limiting access ensures that people are going to maintain an equity position. Whereas in the past, it was all too common to hear about reverse mortgages going upside down and people having no equity in the house. Today, they're designed to be much more sustainable for longer periods of time. So if people are forced into a position where they need to leave the house, there should, in most instances, still be equity available. So these changes, they're big. They're big. And as you can see in the poll here, we got 4 people that did not know about this. So it's a big change that we're seeing. Now, it's government insured. It's FHA insured. So it shouldn't be too surprising that we've got triplicate regulatory protections in place. So not only do you need to go ahead and learn all about this, but the government really wants to make sure nobody's being coerced, nobody's got a gun to their head, nobody has incapacity and doesn't understand what they're doing. They really want to make sure that clients and retirees understand what this is and how it works. So even if they've worked with a financial professional like yourself, even if they're working with a professional like myself, they still need to go through counseling to know how it works.
Josh,
yeah.
Josh, let me stop you for a moment. A couple of our attendees are saying they're having a tough time hearing you and the audio. That may be a connection. Is there by chance maybe a call-in number to hear the audio with this, or no?
You know what? I don't know that I have a call-in option here. Let me double check.
Are you streaming on Facebook Live?
No, I'm not. So my audio. Okay. I can speak up as well, Steve. It might help and open up my speaker a little bit. And,
okay.
Hopefully we'll not have that as an issue. It could be also, depending on where somebody is, it could be the audio on or the internet on their end.
Right.
So, there's, as you can imagine, we're all working through a new normal here. We're all trying to deal with this. So, okay, so it's not my volume. It's choppy. Gary, I would imagine that's probably on the internet side.
Okay. So I don't want to get too. I'm sorry. I just wanted to mention that just in case on that. Let's continue, and hopefully it'll clear up on his side.
Okay. All right. Perfect. So let's dig into this a little bit. This idea of a line of credit and what is a line of credit within a reverse mortgage. There's some really distinct differences between this and a traditional home equity line of credit. And a traditional home equity line of credit, a lot of times in the past, it's what advisors recommended. And it's funny, Morgan Stanley just this last week put out a piece about using a line of credit as a buffer asset and as a protective piece for retirees in today's market. But the line of credit has really, really serious problems attached to it from a strategic standpoint, Stephen. I'm sure you'd agree with this. First, whatever you're getting access to today is what you get access to, and it's never growing. Secondly, if I use the line of credit, I have to make payments back. If I don't pay it in full, it's going to get recast at some point down the road into a fixed mortgage obligation. So I've got some serious cash flow considerations I need to take into account. And then last but not least, the bank does choose if it's frozen, canceled, or reduced. And if you don't think this is going to happen, if you haven't been in the industry for that long, well, back in 2008, it happened to the tune of over $6 billion. And just last week, we saw JP Morgan Chase come out and say, we're halting applications. We're not going to let anybody open these up anymore. You compare that to the line of credit within a reverse mortgage, it's guaranteed to grow. What you have today will grow if you're not using it at the same interest rate attached to the loan balance. It can never be canceled, frozen, or reduced. And if you use it, payments are optional. They're not mandatory. So you can really manage to that as a retiree and as a financial advisor. It's just a tremendous difference as a strategic tool. And I will say that.
And Josh, to confirm, on the reverse mortgage, it's not subject to a credit check or income, correct? It's just as long as it secures your asset. Correct me if I'm wrong there, but it's much easier to qualify for.
Yeah, exactly. So you do have that financial assessment, Steve. So there is some minimum qualifications. You're really being qualified to make sure you can pay your taxes and insurance on the property, not to see if you can make a payment with principal and interest on top of that. So your qualifications are much lower. Really what we look for is we want to make sure that people have a history of paying their mandatory obligations. So if there was a mortgage, for example, have you paid it on time? Have you paid your taxes and insurance? Do you have the ability to, and are you willing to? Because they don't want financially irresponsible people. So yes, this is an avenue where for a lot of retirees, traditional financing might not even be an option, but this absolutely could be.
Got it. Thanks.
Yeah, it is a great question. So the other thing to consider is it could be a hedge on home values, right? Home values right now are at the highest we've ever seen them. Interest rates are incredibly low. From a macro perspective, this is a really good time to look at utilizing home equity relative to other times in history. And if the house does go down in value, your line of credit here, it's not correlated. It is detached from the value of the house. So it can really serve as a hedge. And God bless you, Steve. It can serve as a hedge to your housing value. And this chart really illustrates that very nicely for people. I'm a big fan of the line of credit, but there's a few other differences that are pretty critical to understand. This is an actuarial program. The lenders are not determining access, so credit cannot determine whether or not I'm getting access. It's determined based off life expectancy. HUD determines this. HUD sets the rules, not lenders. You cannot qualify or get disqualified from the value proposition within this. It's one of the nice things about it. And unlike a traditional mortgage, I have tremendous flexibility. If I'm not taking all my proceeds in a lump sum up front, Steve, I have access to change how I'm taking my money. So if I need income today, but down the road I have a financial shock I need to address, I can make a shift and take this out as a lump sum, whatever's available to me. So it's a really powerful tool. And then maybe most importantly, compared to traditional mortgages, which yes, a lot of people carry into retirement. I'm going to talk about this in a few minutes. No foreclosure can occur here because of missed payments, because payments are purely voluntary. They're not mandatory. So I can't be foreclosed on like a traditional mortgage. I'll say this again, it's really important to appreciate this is the most secure and regulated source of financing available to retirees out there. It is unique versus all other sources of financing because there's no personal guarantee on it. That's a really powerful thing for retirees. So without fail, Steve, this question comes up all the time. What actually happens at loan's end? Well, there's really two possible scenarios. I either have equity in the house or I don't. If I have equity in the house, this is something that you'll see commonly with traditional mortgages. I have a choice. Do I want to keep the house and pay off the loan obligation? Well, I can do so if I have the ability and the means to do so. Or I can sell the house, the loan gets paid off, and then the proceeds, whatever equity is available, is going to pass on to the beneficiaries, the heirs, or the estate. In fact, I can actually purchase this home at the end of this for 95% of appraised value, regardless of what that loan balance has grown to. So even if the loan balance has exceeded the value of the house, I can purchase this at 95% of the actual appraised value. So there's a number of protections also put into place for people because upon death, it's a tough time. You might not be on top of all the moving pieces. HUD does give people 12 months to make a decision here and get this sorted out. And again, of course, there is no personal liability that extends beyond the value of the home. You're really, really protected. Michael Keatsy's some great stuff out there. Some of you probably follow him online. I know I do. I'm not going to speak directly to these slides. What I am going to tell is a story I used to tell as a wholesaler. It's a story of 1969 and 1970. In April of 1969, there was a $500,000 portfolio, 4% distributions, adjusted for inflation, and a balanced fund. Over 30 years, that portfolio grew from $500,000 to $3 million. That was April of 1969. That same exact portfolio in January of 1970, under the same circumstances after 30 years, $500,000, still worth $500,000. I'd say those are both pretty phenomenal examples of how market timing can help you. In one instance, I have 6 times the value of my portfolio after 30 years of retirement. In the other, I still have all of my principal intact. Well, that same exact portfolio, same exact circumstances, 90 days later in April of 1970 is out of money in 28 years. Timing matters, especially the first 2 years in retirement. In fact, I think the studies today show the first 10 years really determine whether or not you're going to have success at all. And so what Michael Kitces is saying is we have to prepare for this. This is a new normal. Markets are going to move quicker and quicker. Steve, from my perspective, a lot of it might have to do just with algo trading and some of the pressures on the market today that were never on there from a trading perspective in the past. So it's an interesting thing to me. Market volatility, it's a big deal. We have to be prepared for that. So the body of evidence, I mentioned some names earlier. You can see some in the screen in front of us here. John Salter, I think, is a pretty good friend of the FPA of Miami down here. Harold Davensky is not mentioned on this slide, but he's another local guy that's done a tremendous amount of research on this. We've had Nobel laureates look at this, and the conclusions are all the same. We really do need to be looking at coordinating housing wealth with retirement planning. We cannot look to run down assets to zero first. If we do that, we're doing a real disservice to our clients. We're not helping them. And we're going to take a look at case studies, right? We're at the point where we're really going to start diving into some case studies and seeing how this utility works and really looking at some of these studies, because I don't want you to take my word on it. I want you to really appreciate that the work's been done for you. And hopefully, after looking at some of these case studies, you're going to have a real appreciation for a number of places you can use this as a resource.
Josh, let me pause for a second. I want to encourage anybody out there listening, please write in and type in any questions you might have. Just one thing that came up to me when you were mentioning the financial qualifications, that there needs to show a history of paying their property taxes. What is, once they've taken out the mortgage, does the owner, are they responsible to pay the taxes on their own from other assets, or can that be used to be paid out of the mortgage? Or let's say, they become delinquent or notice. What's the issue with that, and how can you use the mortgage to pay off your property taxes?
Yeah, some really good questions, Steve. I wouldn't be surprised if it's something people are thinking about in the audience right now that aren't speaking up on the chat. You have a few moving pieces to that. So yeah, we are really concerned that people can afford to remain in their homes. If they can't and they don't intend to, you shouldn't be using this as a tool in the first place. So when we look at taxes and insurance, depending on how much equity you have in the house, you can absolutely impound and escrow the money to pay for taxes and insurance into the loan itself. That is based off life expectancy. So it's not like an impound where, wow, I'm putting a couple $1,000s into escrow on an annual basis. We're upfront carving out maybe $40,000, $50,000, $60,000, $70,000, $80,000 to cover those costs over our life expectancy based on the client's age. So that's an option. Okay. If somebody does become delinquent, yeah, there are options here. You're not immediately going to be put into a position where you have to move out of the house. The lender is forced by HUD, however, to start foreclosure proceedings within 6 months of a trigger. And not paying your taxes and insurance is one of 3 triggers. The other triggers being live in the house as a principal residence and maintain the house. So if there's a leak from the roof, fix the roof. If the window breaks, fix the window. So by law, the lenders do have to start foreclosure proceedings, but they are willing, the servicing lenders are willing to work with people to help get the taxes and insurance out of default so they're not forced out of their homes. So it's just one of the other components built into this.
Even if you don't impound that portion of the loan, you can still just take a draw on the loan and pay your taxes as needed, correct?
Absolutely. And
Okay.
Depending on what you're accomplishing with the reverse mortgage, you might have significant cash flow freed up in order to do things like that.
Okay. All right. Well, let's say, what happens if you want to sell the home with an outstanding reverse mortgage? I am thinking of someone needing to move into assisted living.
Yeah, Bill, again, it goes back to one of these previous slides. I'm not going to scroll back on them, but if there's equity in the house, you're just going to go ahead and sell it like you would a traditional home. Whatever equity proceeds are left after paying off the debt obligation and satisfying realtor fees is going to go ahead to the estate, the beneficiaries, the trustee, power of attorney, whomever that happens to be. If there's no equity in the house, that's an instance where you're probably just going to do a deed in lieu of foreclosure. There's no reason to take that responsibility on as a trustee. Just hand it off to the mortgage company because there's no money remaining in the house. In that case, you've spent down all the assets in the house. It's a dead asset. So hopefully that helps answer your question.
Thanks, Josh.
All right. Let's actually look at some case studies here. And for a moment, we want to look at what my options are with proceeds from the house. If I'm tapping my equity, if I'm going into that vault, I can take a lump sum, I can take an income stream, and I can create a line of credit. I can do all three of those things. And I can do a combination thereof.
There's other stuff to do. God, no, he can spread it out.
Hey, Steve, I apologize. I just muted your mic for a minute to cut back on the background noise. So hopefully everybody can hear a little bit better. So as you can see, you've got options here. You've got lump sum, income streams, and line of credit, and a combination thereof. There's really a lot of utility. And the first utility really starts with lump sum client scenarios. So I know a number of you haven't ever recommended a reverse mortgage. I'm curious if anybody's recommended it as a lump sum for client scenarios. So Steve, I know we have a poll set up here. Thank you. You got it up. It should be showing up in front of everybody in a moment. I like to inject a little humor here. So if you've never used a reverse mortgage, tell me to quit asking. You don't care. And actually, that's a line of credit. So we're gonna actually talk about lump sum, Steve, not the line of credit. We'll jump on the line of credit later. That's an important one. There's 4 utilities though that you can take a look at for lump sum. Number one, I deal with this a whole lot. Retirement to me is cash flow, and we have an income factor and we have an expense factor. And again, with income, we kind of have a ceiling on that. We have a limit on how much we can draw from our assets safely. Well, with expenses, a lot of times the easiest thing we can do is reduce expenses. And believe it or not, 44% of retirees carry a mortgage obligation into retirement. That's right, nearly 1 out of 2 are carrying a mortgage obligation into retirement today. It's a big number. So number one, I happen to work with advisors quite a bit. The second one, I haven't met an advisor yet that's heard of this before I've spoken with them. Purchase a new home with a reverse mortgage, a really powerful tool, especially considering how much equity people keep in their homes. And we're going to walk into that as well and walk through that. Establishing a housing equity and silver divorce. I'll kind of gloss over this a little bit. We'll speak to it briefly, and then using a reverse mortgage to own 2 homes, another option for people. So let's dig into number one, because this to me is a really great thing for you to know about as an advisor. And I encourage you, again, don't take the studies on their words. Use your planning software. Look at a case study. Look at the numbers. Here we have Mary and John. They're 65 years old. They've got a house worth about $541,000. They have 10 years left on their mortgage. It's almost a $1,300 payment per month, or $15,574 per year. They are going to look to replace this with the reverse mortgage, the home equity conversion mortgage. They will not have mandatory payments. Yeah, that's funny, Steve, right? I just saw your chat. They're not going to have mandatory payments if they do the reverse mortgage. In addition, they'll have a $99,000 line of credit available. Again, they can use that however they see fit. And we're going to look at 4 scenarios. We're going to look at the reverse mortgage with voluntary payments, the reverse mortgage with no payments. We're going to look at taking a lump sum distribution out of the portfolio. And we're going to take a look at what if we just keep paying off the mortgage as we are, and if we need to, use a reverse mortgage at the end. So those last 2 options, by the way, that's traditional financial planning. That's what we've all been kind of taught to do over the years. And here's my takeaway from this chart. And Steve, to me, this is really impactful for everybody. This is directly out of Wade Pfau's book. You want a copy? Let me know at the end of the class. I'll bring you a copy personally, or send it to you right now with what's going on. What you're seeing here, and I'm not sure how large this is on your screen, but what you're seeing here is the 2 best probabilities of success in retirement are predicated on replacing that mortgage right now, early on, before we take money out of our portfolio, or before we take our cash flow and use it to continue paying off that mortgage. Does it matter up front in the first few years of retirement planning? No, but none of what we discuss today matters in the first 10 years or so of retirement planning. If it did, and that's all we had planned for, we wouldn't be having this conversation. We have to plan for 30 plus years. And when you look at that 30-year mark, you're seeing the difference between success rates at the 40 to 50% mark and success rates over 60%, simply by integrating the housing wealth up front. Now I'm going to switch over to that poll because I saw this. Have you ever recommended to a client to use a reverse mortgage for lump sum uses? We've got 6 answers. They're all no. So nobody's really ever recommended this as an option. And yet statistically, the odds of success are so much greater. So I really work closely with advisors a lot of times with these clients because, again, 44% of people fall into this profile. It's pretty often. Now, the HECM for purchase, I love. This is in its infancy. The reverse mortgage signed into law back in '88. This came out in 2009. It's 11 years old. Almost nobody knows about it. Imagine you can buy a house in retirement if you're 62 and up, and instead of paying all cash, you come in with about 50 to 60% down, and the money you're borrowing, the difference there, you never have a payment on. What kind of utility could you have with that? How much equity from a house you're leaving could you then funnel into investments and other financial objectives? Arguably a lot. When you look at this matrix on the left here, the age of the youngest borrower, you can see a 70-year-old for a $350,000 house only needs to put down $200,000 to purchase that house. Now, I will point out the legacy home has nothing to do with this. This is purely based on purchasing a new home and using the reverse mortgage as the purchase transaction. And when we look at this and we look at a client case study, it's really interesting. This is an upsizing case study. This is somebody who says, I want a good lifestyle. I want a very specific place in retirement. It's going to be nice. I'm selling a $500,000 house. I'm going to net $460,000. I'm purchasing a $700,000 house. I only have $460,000 to move over from my equity in my existing home. So I'm going to dig into the portfolio. I'm going to cannibalize the assets you're managing, and I'm going to go ahead and withdraw $240,000 to buy this house cash. Well, if we compare that to HECM financing, we can actually lend $300,000 on this $700,000 purchase, which means if my equity position from the sale of my house is $460,000, I only need to bring in $400,000 to close, which means I am taking $60,000 from my previous home, and I'm now using that to go and supplement and strengthen the portfolios you as a manager and a planner are helping somebody with. Really, the delta here, though, from this scenario, from the left to the right, it's $300,000 because I'm not cannibalizing $240,000. We know what kind of impact taking a distribution of that size can have on a financial plan. You might have trouble seeing the screen. I don't want to focus too much on it, but some of you might recognize this. This is Money Guide Pro. So what you're seeing here is financial planning software being used to really run the numbers, which I encourage you. And what you can see on the left-hand side is our probability of success is below 40% if we cannibalize that portfolio. If we use the HECM for purchase, my probability of success has jumped all the way to 68%, from sub 40 to 68% for this client. It's a massive difference in retirement success. It's the difference between being able to have the home they want in retirement and not. So it's really showing the value of coordinating the housing wealth in a unique and creative way. I'm a really big fan of that feature. Most advisors, I think, would be really on board with that concept, Steve. And I know you're still muted here, so give me the thumbs up if I'm able to unmute you. All right. So I'm going to unmute Steve here in case he does want to add anything to our conversation here. We should be able to hear you in just a moment, buddy. Yes. Yeah.
Can you hear me? Okay. Yeah.
I
Sorry
can.
about it. That prior required muting was unexpected. So if it comes again, I'll give you another scenario. No. But no, sounds great. This is great, powerful, seeing it in an example.
Awesome. Fantastic. All right. The silver divorce. You know, this is a funny one. I don't deal with this too often, but what you need to know is, demographically speaking, baby boomers and seniors are divorcing at 3 times the rate that they were 20 years ago. It's the fastest growing divorce segment, demographically speaking, in this country. It's an issue. And why is it an issue? Well, you don't need me to tell you. It's probably one of the most significant financial shocks you can have in retirement planning. There's really 2 ways this could work. Somebody's either going to want to stay in the existing home, or both people are going to want to leave the house. If somebody's going to stay in an existing house, the challenge for you as an advisor is a lot of times that means the actual investable assets are really going to be heavily weighted to the spouse leaving the home. So if anybody's dealt with this before, I'm sure they've experienced this. The reverse mortgage would allow the spouse remaining in the house to pull out about 50% of the equity. They can then give that to the spouse leaving the home. That spouse can go ahead and purchase a new house with the HECM for purchase. So it's really 2 reverse mortgages here, 1 for each of them. And then they can both have similar homes of similar value, and neither of them are faced with cash flow issues for remaining in those houses. It's a really powerful concept. Alternatively, if both are leaving the house, we're going to sell. We have proceeds. They'll be split. A lot of times the clients and divorcees, they want a certain lifestyle. This will allow them to live in a desirable home by using the HECM for purchase, each of them. So they're not interrupting their lifestyle, even though this divorce is happening. And of course, again, there's no debt service here. There's no mandatory payments. So we're preserving cash flow in what could be a really dangerous situation for retirees. So this last one, I'm gonna walk through this really quickly, Steve, but I think it's a good case study of what you could really do with a wealthy client. We have somebody here, real life case study. They had $1 million home. The ceiling for a reverse mortgage FHA today is $765,000 and change. In this instance, the client was able to draw out $350,000. They purchased a vacation home with the money. So reverse mortgage, primary residence, the house they live in today. They purchased a vacation home. They rented it out when they weren't using it. They started receiving income from rent. They have appreciation in both their homes. Rental income can actually be offset with depreciation to keep taxes down. And they're able to take some of that rental income and purchase a second to die life policy for $750 face value with an LTC hybrid rider. So they now have LTC coverage that they did not have before, and their heirs are going to have a $750,000 death benefit available to them if they don't use that LTC coverage. So when you look at this and you say, well, what can we accomplish for somebody who actually has assets here? It's quite a bit. There's a lot of leverage we can take advantage of when we're talking about a home that's a significant portion of somebody's wealth. In this instance, just the LTC coverage alone is arguably worth its weight in gold if the client doesn't have it.
Josh, what jumps out to me here is when we have a securities client and they take a loan against their portfolio, one of the biggest limitations is you can't use that money to buy other securities with it. So I guess what you're showing an example here is that money in the retirees, the homeowners' hands, they can do whatever they want with it. Is that correct? Is there any limitation?
Yeah, it's for the most part correct. I think you as an advisor, you need to take a close, hard look at this idea of borrowing money as a lump sum in order to purchase another investment of any sort. I think you need to be comfortable knowing that there's some compliance red flags there, depending on the broker dealer you work with. And Steve, you and I have had this discussion. There's a reason you went the RIA route, because of broker dealer compliance issues. And it wasn't about this scenario in general. It was just, why can I not discuss some of these tools out there at all? So you do need some protections in place, I think, for yourself as a business person. And I'm the first to tell you, do I think this is a good thing to do? Do I not think it's a good thing to do? I'm going to give you my professional opinion as somebody who's been in the industry and knows compliance really well. I know what your risks are. I know what you need to be careful of. So there's, from the client's perspective, there's no limitation for what they can use the money with. But I think for you as an advisor, if you're going to do a strategy like this, you just want to make sure that you're really, you're putting in the time to make sure that the numbers bear it out. And that you're really following a fiduciary standard when you do this.
That's a great answer, Josh. And just to share with those on the webinar, as I told you when we met, when I was with an independent broker dealer, I had one email flagged by compliance in my 4 or 5 years there, and it was literally me trying to refer someone, I believe to you, as for, or maybe previously for a reverse mortgage. And yeah, that just goes to the stigma and this idea in that other environment. They're unreasonably prohibiting you. Was one of the many reasons why I went the way I did, to be able to work with clients with these.
Yeah, and I'm going to speak to that in a few minutes once we get through these case studies, because that's a really good point, the liability side of things, and it really does need to be addressed. So let's move on. So here we have monthly income streams, and I am going to try to walk through us fairly quickly on these, because I want to be sensitive to the time we're at. This is a more traditional scenario. I'm going to take an income stream from a reverse mortgage. Typically, we see this when people have drawn down their assets to zero, Steve. Again, that's what we're trying to prevent in almost all instances. So we're going to look at some options for this early on, beforehand. And Tom Davidson is a CFP. He ran these numbers. He had a client that was looking at drawing Social Security early at 62. That's that aqua graphic on the bottom there. 12% success rate if the client did that. Not a good situation. So what he looked at was, well, what if we used a reverse mortgage to create an income stream? And he found that he could do that for 6 years. By age 68, there was no more income available to replace Social Security. So he took 2 years of investment distributions from the portfolio. But look at the difference in probability of success here. At 94, this client has $1 million of assets with a 90+% rate of success built into this, or an 89% success rate. It's just a massive difference. So this Social Security bridge concept is really starting to gain traction for a lot of people, because where else are we going to get 7-8% guaranteed growth on our income streams? You just don't see that anymore today in the marketplace. So it's almost impossible to replicate the benefits Social Security can give people if we're planning for long term. Here's another case study built off of Money Guide Pro again, just taking a $1,200 income stream for a client on a monthly basis. And this is a client that needs $72,000. They've got assets. We're talking $1 million+ in assets here. They have Social Security, but the house is worth over 30% of their overall wealth. And if we just use the house to create an income stream early, our probability of success goes from middling, 58%, all the way up to 96%. I mean, it's just a massive shift in the client's retirement picture. And I don't know how many people on this class, Steve, are okay with a 4 out of 10 failure rate, but I don't think most clients would be. So this is something that your conversation would probably ordinarily be, well, that $72,000 needs to drop. We can't have that level of expense with your assets and your allocation. Take more risk or reduce expenses. Well, now you have a third option to have a conversation with the client with, and I'd argue it's probably a much cleaner conversation that's going to go a whole lot better. Now, Jerry Wagner did a great study here. I'm going to walk through this pretty quickly, but I really love this study. He looked at the 4% rule. It's back in 2013, so it's a little stale. But he looked at the 4% rule. He looked at taking 6% from a portfolio, and then he looked at using the reverse mortgage to create an income stream from the house in addition to pulling money from the portfolio. And he looked at periods of 30 years and then 37 years. And just what jumps off the bat to me here, Stephen, what jumps off the page, and it should jump off to everybody, is you have the same probability of success drawing out 6% from a portfolio with a reverse mortgage income stream than you would if you just pulled 4% off the portfolio. So in other words, if we're creating $10,000 of income from a portfolio, we can increase that to $15,000 with the same probability of success of never running out of money. That's a big deal. Even in longer term, 37-year retirement windows, a 3.25 distribution rate's giving me a 9 out of 10 success rate, pretty good. But I can jump that all the way to 5.5%, and that's big. I mean, if we look at 3.25 off $1 million, that's $32,500 before fees and before taxes. That's not a lot of money for most people. So being able to jump that up to 5.5%, that's a huge shift. It's life-changing. It's game-changing for retirees. So those are some of the income streams we can look at. It's not about creating an income stream when I've run out of money, because again, you may very well not even be able to do this. It's about creating an income stream early to preserve the assets and reduce the risk. So line of credit, we already saw, you did the poll earlier. Most people are not using line of credits here. The idea of a standby reverse mortgage, just opening it today so I have access, is not something that's used often. But there was some really good studies done by Barry Sachs not that long ago. And what he's showing here is, well, if there's a down market, instead of drawing from my portfolio, what if I just drew from the reverse mortgage? What if I created a line of credit so I don't have to take distributions and deal with sequence of return risk? And what's it work out to? Now, you're not going to be able to see these slides very easily. So I'm going to shift over to the very next slide. But what it is showing is that you're running out of money using a traditional portfolio after 22 years, I believe, 23 years. Whereas if I just used a reverse mortgage line of credit, I'm not running out of money at all. And here's the delta. Here's the difference we can see. So in scenario one, my portfolio's gone to zero, and I've had to borrow money from my house, which is why I have a negative $538,000 balance on my estate. With scenario two, because I've used that reverse mortgage during down markets and avoided sequence of return risk, I actually end up with a portfolio value of just under $400,000 upon death. The delta here, Steve, it's almost $1 million, $933,000. This concept, nobody is using right now. And it's unbelievable because as a buffer asset and sequence of return risk, it can make a huge difference in our planning. It's one of the greatest risks we have in retirement is taking distributions during a down market. This helps prevent that. So it's a really powerful tool. Self-insuring long-term care. I'm not going to really dig into this case study. I'm going to speak more generically. I can promise you, if you've been in this business for any number of years, you've run across clients who cannot get LTC covered. They're not eligible, or the cost is so prohibitive, they're unable to do it. Well, you can use this as a buffer asset for LTC needs because our line of credit is guaranteed to grow, because the assets that we're taking from the house are tax-free. We can create a lump sum or an income stream that will help us address LTC needs down the road, which can make a massive difference. Avoiding that financial shock could just make a tremendous difference for people long term. And it's not just about LTC, right? It could be liabilities. Your clients could get sued for driving down the street and hitting somebody and they don't have an umbrella policy like they should. It could be liquidity shock, divorce shock, portfolio shock, sequence of return risk. There is so much here that puts us at risk in retirement. And again, we don't have second chances. We do not have the opportunity to go back in time and fix this for clients. So we just need to bulletproof plans as much as possible. And I'm already seeing the poll answers come up. Has this changed your views? And I'm glad it has. I'd be shocked if it doesn't, at least a little bit, because if you weren't aware of these changes, my gosh, what would you think? And most of us have never really dug into these studies. But I'm here to tell you, we can no longer ignore it. And Jamie Hopkins really says it well. He really, really says it well. He had an article in Investment News, I think 2 or 3 years ago, where he talked about having the same liability today that advisors had back in the 90s when they weren't discussing long-term care. If you had an advisor that wasn't insurance licensed back in the 90s, it just never came up as a topic of conversation. Well, guess what clients and their beneficiaries started doing when mom and dad started ending up needing LTC, and they realized this tool is out there all along, and the advisor just never told them because they didn't get paid on it. Well, he started suing. Of course they did. And the attorneys were happy to have that conversation. Oh, that's a home run. They didn't talk to you about it because they can't sell it. So what? Well, that's the type of liability that you need to think about as a fiduciary. Do I need to start having this conversation? Because if I don't, what kind of risk am I taking on? And Steve, this is where I think the broker-dealers have it all wrong. They're looking at liability and they're saying, okay, let's manage to the lowest common denominator. Who's the stupidest advisor that we have that can make the stupidest decision, and let's solve for it. Well, let's solve for it by saying you can't even discuss this. Housing wealth, not an option. We don't make any money off it. You don't make any money off of it. We're not willing to take the liability. Well, I think it's backwards. I think they're taking all the liability on their shoulders. And I think when we start running through more and more retirees who are ending up with no money before they pass away, this is going to start working its way through the system. And it's a reason why we're seeing broker dealers make such significant shifts over the last few years in how they view this. So, yeah, in conclusion, I'm not going to read off this slide for you. I think most of you on this webinar right now who have listened through this have probably come to the conclusion, okay, yeah, I get it. It makes sense. There's utility here. But the number one question I actually get asked is, how do I have that conversation with somebody? How do I even bring it up? Steve, I think you and I just had this conversation not that long ago. How do we have the conversation? And by the way, I just asked Steve to put some call of actions up there. Don't click on them yet, because if you click on them, it's going to move you outside of the presentation. Give us 2 more minutes, but we want you to know that you can reach out to me directly if you think it's worth discussing a specific client. And you're also going to have a chance to go over to the FPA website if you think there was a lot of value in what we talked about today, because this is just the first of a lot of courses we're going to be offering with the FPA. So how do you have the conversation? Well, you kind of saw it in the case studies already. It should be a part of your planning. You should be looking at different scenarios within the financial planning software to give your clients not an opinion, but fact. This is the difference if we do it versus not. This is the impact it will have. This is how it will help us achieve our goals. That's step number one. But from my perspective, conceptually, it really comes down to this. Clients are unaware of the challenges that are ahead of them in retirement. Their parents didn't go through it. Their grandparents didn't go through that. They don't know that financial planning has changed. They don't know that the house as an asset needs to be coordinated with retirement planning. And it's your responsibility as an advisor to say, hey, listen, it's changed. The environment's changed. What we deal with has changed. We can't leave this until the end, and then show them why. And if you do that, I think you're going to have way more success having a conversation with clients early. You're going to eliminate any liability, and you're going to be able to significantly increase probability of success for clients ongoing, not just today, but long-term, no matter how long those retirements last for.
Josh, thanks so much. This was wonderful. This is great. I mean, honestly, every time you and I talk, and now I see this presentation, I literally learn new things about the reverse mortgages. And it's just great. My evolution from it, I work with a lot of younger accumulators and a lot of people, and it's a good idea. And it's kind of many people were raised that I want to pay off my house as soon as I can. I want to pay down my mortgage. And many times when clients come into lump sum, I absolutely recommend that as a great course of action. It's never a bad decision to pay off debt. And now I'm going to start introducing, and I am, the conversation more. Okay, it's great, it's going to be paid off, but understand, if we need your house, it is, to utilize, to help you later on in life, the reverse mortgage is a great option. So just to have that conversation and prepare them, because it's such a unbelievably vital tool. And I'm glad we have these opportunities to share with people and to be able to share with their clients, just how important they are. So Josh, I think I messed up the call to actions. I see the FPAs, but I don't see where yours went.
Yeah, and that's okay, Steve. On my end, I'm certainly going to send an email to everybody on the back of this. Bill just asked me for this letter template. I'm going to make sure he gets a copy of that as well.
Okay.
I'll have my information available for people. My big ask, Steve, is first of all, if you're not a member of the FPA right now, at least consider it. It's a tremendous opportunity to learn, to educate, and to get shoulder to shoulder, at least virtually, with some great professionals. But also, if you found utility today, let's look at a specific client. I don't want to keep this conceptual. I want to take a look at what kind of impact would this have for somebody. So if I did a good job today, chances are you thought of somebody. You said, wow, so-and-so client fits that profile. Let's actually dig in and see how that looks. So we can the only handout I could access came up in an evaluation. Yeah, Gary, that evaluation, by the way, that's the most important handout. So definitely take that, download that, and fill it out and get it back to me. Everything else I can give you access to via email afterwards. So if we have any issues with the technology, I don't want you to get too concerned about it. But certainly, I appreciate the honor to be in front of you. It's a real privilege, Steve. Thank you so much for moderating today.
Thank you, Josh. And let everybody know we're going to close up here, but we're going to start accumulating these presentations, and we're going to have them on our website for our members to access and to review, that not only to talk about a case, but to say, hey, listen to their other friends, other advisors. This was really educational, and hopefully they'll be able to go and access.
Yeah, that's awesome. Well, thank you very much. All right, everybody.
All right. Thanks, Josh.
All right. Housekeeping, one last item, Steve. Again, I need those evaluations back to get you CE. Please send them to me, and I'll get everything processed early next week.
Awesome. Thanks, man.
All right. And Gary, I'll touch base with you offline, my friend. Thank you.